Hello, I'm Alicia Barry. Welcome to the Business Summer Series. Coming up, some of our best stories on the finance industry. Risk it for the biscuit. Equity crowdfunding's a game changer for private business, but is it on the money for investors?
There are a group of investors out there, like the millennials, who are looking for something different.
And financing the faithful, the $250 billion market for interest-free banking.
You can't eat the bacon, you can't have that non-alcohol. The biggest one is interest.
Also coming up, the $5 billion rip-off. 1 in 4 workers are not being paid their superannuation. But first, with the growth of digital wallets, buy now, pay later platforms and cryptocurrencies, the way we pay for things is rapidly changing. The Treasurer says consumers need more protections and businesses need more certainty over regulations. Josh Frydenberg says the federal government is planning the largest reforms to our payment system in a quarter of a century. Amelia Terzon reports.
Damien Nguyen put more than $2,000 into a cryptocurrency exchange that just collapsed.
I definitely want there to be some sort of protection so that we don't lose our money trading.
That's now in the federal government's sights.
A very significant change to the plumbing of Australia's financial system.
Under the proposed reforms, crypto trading platforms will need financial licences.
We've effectively got a banking system also in the cryptocurrency space, which is effectively unregulated at this time. So the government does need to step in.
It's also flagging support for a central bank digital currency and more regulation of payment services like Tap and Go offered by Apple and Google.
With the certificates and people using their phones, even the older generation are becoming more tech savvy.
More than half of all in-store payments are now done with phones or digital wallets. Australians are using buy now, pay later apps for 1 in 5 online sales.
I want to make the rules here in Australia. I don't want the rules for our payment system being set in Silicon Valley.
The banking sector has been pushing for these reforms for months.
Right now, those big tech companies don't make any financial contribution to Australia's payment system, nor do they let existing Australian players use any of their technology.
The federal government's overhaul of payment services isn't expected until the end of next year. Of course, we're heading into an election and anything could happen. The opposition says it also supports more consumer protections. Until then,
Don't trust everything because in the blink of an eye you can pretty much lose everything.
a warning to others trading in the digital age.
Retail investors are pouring millions of dollars into unlisted startups, small and medium-sized businesses through equity crowdfunding campaigns. It's being celebrated as a way to democratise raising capital. But is it really a smart way to invest? Rihanna Whitson reports.
When this Indigenous-owned non-alcoholic beer company wanted to expand, it raised $1 million from 580 mostly retail investors through equity crowdfunding.
It's a range of people from a whole bunch of different backgrounds. We got a good handful of First Nations peoples who have signed up to be an owner, which is awesome.
In Australia, there are 15 licensed equity crowdfunding platforms. They run online capital raising campaigns for unlisted startups and small to medium-sized companies. The maximum a business can raise a year is $5 million, but it can come from an unlimited number of investors. If the campaign doesn't reach its target, the money is returned. For as little as $50 and up to a maximum of $10,000, you get a proportional shareholding.
In the old world, raising capital, you're having coffees and meeting people in the real world, but ours is an entirely online process.
Today, I want to ask you to become my business partner.
The hype around equity crowdfunding is growing. An eco-cleaning product brand was able to raise $5 million in 6 hours.
There are a group of investors out there, like the millennials, who are looking for something different.
Last financial year, equity crowdfunding platforms raised $46 million. That's a 125% increase on the 12 months prior. Globally, the industry is worth around $2 billion. The biggest markets are the United Kingdom and America, with Australia ranking 7th. Becky Smallchow is one of 1,600 investors who bought shares in cosmetics company Kester Black, which raised $2 million.
They're leading in the beauty industry, changing up the way things are done, using business as a force for good. And that's something that both my husband and I really believe in.
I would say 50% invested around $250, and they're literally just customers, loyal followers of the brand.
But is equity crowdfunding a smart way to invest? Well, it's considered riskier than buying shares on the stock market. That's because you're pouring your money into a startup or less established company, which could have a higher failure rate. Your shares will also be more difficult to sell because there's no secondary market to cash them out on, and you could be waiting a lot longer for a return on your investment if you get one at all.
You need to do your due diligence, do as much research as you can.
And you need to be prepared to lose your investment. Zinja collapsed in 2020, and while the neobank returned its deposits, investors who poured in a total of $5 million were left empty-handed.
I am disappointed. I've lost money, but that's the game.
While acknowledging the risks, those involved in equity crowdfunding say the platform means you don't have to have rich connections to raise cash.
I think it'll be a very inviting platform for many First Nations businesses to be able to get the guidance and the support that they need.
Soba is using the money it raised to build a brewery, triple its production, and plans to deliver a return to investors within 5 years.
Rihanna Whitson there. 2021 saw a record number of firms, more than 200, listing on the stock exchange. That's the most since 2007. Shareholders and businesses are hoping all the added activity will deliver strong returns. Rachel Papazzoni reports.
It was cheers all round as Nimue Resources launched its initial public offering.
It's very exciting. It's been a long road to get to this point.
The Nickel Explorer raised $6 million ahead of its listing to give it more money to spend on exploring its discovery in Western Australia. An initial public offering, also called a float, is when a privately owned company goes public to raise cash by selling off parts of the business known as shares on a stock exchange.
It takes about 12 months of planning and regulatory approvals to get to this day. Despite that, Nimue Resources has just become the 204th company to list on the Australian Stock Exchange in 2021.
This is a record year by number of listings since 2007. It's also a record year in terms of capital raised since 2014. But perhaps most importantly for us, it's an all-time record for a number of companies listing with market caps over $1 billion.
Analysts say there's extra cash floating around thanks to government stimulus and record low interest rates.
Companies are positioning themselves for future growth, so they're looking to bolster their balance sheets.
More than half of this year's IPOs have been resources companies. It was a similar story in 2007 when 251 firms went public.
We're actually seeing the biggest recovery in the mining sector in over a decade.
Christian Price has been working on Nimue Resources' IPO for months.
And then building your team with your lead manager, with your legal team, and also with your the board and management to get all that mix right. And especially important is getting your geology team right with that right experience in nickel sulfides and discovering nickel sulfides.
Among the countless hours of due diligence and paperwork required is the prospectus. It has all the key information about the company's risks, management and financials.
Once the paperwork's been lodged with the regulator ASIC and the ASX, it's time to go to market to find those all-important investors.
In October, software company ActivePort listed for 20 cents a share, raising $12 million.
The main interest for us out of the IPO is growing quickly and growing internationally.
The company's share price has fallen back since then, a phenomenon that often occurs once the hype of listing calms down. Sometimes the price never goes back up, like retailer Myer. which listed at $4.10 a share in 2009 and has never traded above that since. It's been as low as 10 cents in 2020. ActivePort wants to make sure that doesn't happen to them.
What we're finding is the market is now saying, okay, we understand what you're doing, we understand the way you're going to do it, show us the numbers.
If the numbers are good, shareholders reap the benefits. Analysis by global asset manager Janice Henderson shows Australian dividend payments grew 4 times faster than the rest of the world between July and the end of September. With even more cash floating around, there's more incentives for companies to list.
We're very, very optimistic short term. We see nothing that slows the market down.
Which could mean the IPO momentum will continue in 2022.
Australia's $3 trillion superannuation system is supposed to make sure we all have a comfortable retirement. But data reveals 1 in 4 workers are being ripped off by their employer, amounting to more than $5 billion each year. Nassim Kadem has this story.
Annie Wang was just 19 years old when she realised her employer wasn't paying her superannuation. After 3 years, she took legal action to recover $8,000.
It's so costly, especially for a student. You have uni stress, school stress, normal everyday stress, and on top of that, you have to worry about work.
Ms Wang is one of nearly 3 million workers missing out on superannuation each year. In total, they're being underpaid $5 billion annually, with each worker losing an average of $1,700. It typically happens in industries employing lower skilled workers, and it's usually smaller businesses that are responsible.
It affects about 1 in 4 Australian workers. And, this is their money. It belongs to them. It doesn't belong to employers.
Greg Hislop was working as a head chef at a pub when he discovered his employer had not paid his super. A life-threatening infection meant he had to have his leg amputated from the knee down.
I lost my wage, I lost my job. It also took away, mainly the future that we had planned. We were looking at buying a house, we had a deposit, but yet we've had to go through half of that just to survive.
Apart from not being paid an estimated $20,000 in super, he lost out on almost $60,000 of insurance. The disability cover lapsed because his employer was not making super contributions.
I would have been able to cover myself and get back on my feet, but unfortunately that's been taken away from us for God knows what reason.
In cases like Greg's, the boss of Industry Super Australia says penalties are available, but the ATO needs to flex its muscle.
We've been worried that the penalties are woefully inadequate. We've also been worried that there's been very little deterrent activity.
Even when workers go to court and win, it can take years before they're paid back their super. Margaret Joyce is waiting for almost $6,000 and is worried she'll have to rely on the age pension.
I definitely won't have enough to retire on.
Superannuation Minister Jane Hume says the tax office knows what superannuation is owed because of the introduction of real-time payroll information.
The government has a zero tolerance to employers that don't pay the appropriate amount of superannuation to their employees.
But Shadow Superannuation Minister Stephen Jones says the government needs to do more.
Change the law to ensure that recovery of superannuation is treated the same as recovery of any other wages.
When a company goes bust, it can be hard for workers to recover their superannuation. Over the past year, the ATO has fined employers more than $240 million. Company directors can also face penalties, including prison time. But the ATO says no one has gone to jail over the past 12 months.
If a company has already been deregistered, then it no longer legally exists, and so the ATO is constrained from taking any further action in those scenarios.
The tax office hasn't been able to recover Shinda Kwa's $16,000 in unpaid superannuation because her employer is no longer registered. She was working on a temporary 457 visa as a chef.
Really, I think they're taking advantage from the migrant people. Really, they push them hardly. Unfortunately, this means there is no business or company for us to take action against.
She also missed out on wages, but has been able to get that money back by complaining to the Fair Work Ombudsman.
I was literally crying that time. because of my situation, because we don't have enough money in our accounts. What color is this one?
Not enough money for today, and definitely not enough for retirement.
It's valued at almost $39 billion, but Afterpay still hasn't turned a profit. With tough competition from bigger global players, the Buy Now Pay Later firm is subject to the biggest corporate takeover in Australia's history, Nasim Kadem reports.
It's the dream of every startup. Take an old idea, bring it into the new online world and see it take off globally.
Particularly in North America, is very strong. We've named some very large retailers that are coming online very shortly, which will continue our expansion.
Nick Molnar and Anthony Eisen have made modern-day lay-by service Afterpay so popular with millennials that it's now the subject of a $39 billion takeover by US payment giant Square.
We're really proud now to pass over 100,000 merchants globally accepting Afterpay.
Afterpay is now looking to mine data on its 16 million customers to get them to shop more and provide personalised information to retailers.
The millennial and Gen Z consumer will represent 50% of all retail spend globally by 2030. It is the core consumer base that retailers are focused on in acquiring.
The pandemic's pushed more shoppers online. Afterpay's revenue grew by 78% to almost $925 million following strong growth in America. But the company still hasn't made a profit. Loss after tax rose almost 700% to more than $156 million following rising marketing costs and staff share schemes.
As we continue to focus on both top line and margin, as we scale, that will translate to the bottom line.
Fund managers who have big stakes in Afterpay intend to hold on to the stock for the long term.
We haven't seen a deal that makes more strategic sense than Square and Afterpay. You know, they both understand the next generation.
But the Buy Now Pay Later market is becoming more crowded, with global giants PayPal and Klarna competing for consumers. Local player Zip is also catching up. Customer numbers jumped 248% in the year to 7.3 million. The company made a $653 million loss, partially thanks to the cost of acquiring US business QuadPay. But Zip posted a 150% jump in revenue to hit a record of more than $403 million, led by strong growth in America.
The size of the market in the US is so significant, it's underappreciated potentially by Australian investors.
Buy Now Pay Later sales only make up about 2% of online payments globally. Companies like Afterpay and Zip want to gain a bigger share of that lucrative market by adding smaller merchants to their list of big-name retailers.
Sasha Wicker offers Afterpay in her Melbourne fashion store. She's being charged 6% in fees for the privilege.
For a small business like myself, it eats into my margin, whereas I think with the bigger big box retailers that have a bigger margin, wouldn't affect their margins as much as mine.
Being able to maintain merchant fees has been core to Afterpay's success. It makes a small amount of money from consumers being charged late fees if they don't pay on time. But for now, the industry has escaped new regulation.
The customer outcomes here are better off because of innovations like Afterpay and new methods that don't rely on the traditional economic model where somebody has to lose for another party to win.
But if customers do start losing out because of Buy Now Pay Later debt, regulation could still be on the cards.
In an Australian first, one of the big four banks is offering a lending product just for Islamic businesses. NAB signed on with a property developer, giving them a Sharia-compliant loan. A market research suggests could be worth as much as $250 billion. Amelia Terzon this time.
For this Australian family, adhering to faith extends to finance.
can't eat the bacon, you can't have that non-alcohol. The biggest one is interest.
Islamic banks or Islam in general tries to avoid that.
And that's tough because interest dominates the banking system, including Dolomite savings accounts, which Malika's had since her childhood.
We don't actually keep the interest. We could choose to donate the interest that's accumulated, for example, which is what I do.
Anything that needs to be direct debited gets direct debited and the rest having cash.
Home loans are more complicated.
I've always wanted to go down the path of not using interest.
Then the couple heard about Islamic finance. Unlike conventional mortgages, where you buy a property with money from the bank, which you pay back, plus interest and fees, deals brokered by Islamic finance companies are being done under rent-to-buy agreements, where you still hand over a deposit and the institution buys the property under a risk-share agreement. They then lease it to you at a monthly fee, comparable to the current interest rate. They make a profit until the customer eventually owns the property outright.
This is what you're going to do. This is you, that's me.
The model is complicated to fit into Australian laws, but it works for Ibrahim and Malika. They've flipped 3 homes using Islamic finance.
Now that this is available for us, we're quite happy.
Zara and Hala Cercius are also happy. They haven't bought a home yet, but recently they pulled their super out of a major fund into one designed for their beliefs.
The funds have to come from a clean source, so that rules out the whole tobacco industry, gambling industry.
Islamic financing companies are brokering loans for small businesses, including this halal butcher.
Very, very grateful that enable us as Muslim businessmen to grow. It's a halal butcher in a halal investment with a halal super.
And it's not just small business. The National Australia Bank has just made history by launching a product for property and construction companies needing finance above $5 million.
We've worked with global Sharia scholars to develop a lease-to-own type structure, which is called an Ijara Muntayba Tamlik, that fits the Australian context, but at the same time remains true to Islamic principles.
And that opens the door to offshore investment.
We're next door to one of the world's most populous Muslim nations, Indonesia, along with other Muslim majority countries in the region.
An industry report has found that Islamic finance could be worth $250 billion to Australia's economy. But with only a tiny fraction of the 600,000 Australian Muslims involved, it's clear that the sector is still very niche.
The Muslim community, it's not a monolith. It's different views, different backgrounds. I don't think 100% of Muslims are going to jump into Islamic finance.
The companies offering services here are doing so under credit licences, but they can't take deposits. Some believe the market could take Australia's first Islamic bank.
We've only got literally 1% of that market covered. There's still 99% to go. It's a large market.
His institution and a rival startup, IBA Group, are applying to the regulator APRA for restricted banking licences.
That means that when we first kick off, we'll be offering transaction accounts for everyday banking, we'll be offering savings products.
That's something that Ibrahim says he'd use.
100%. 100%, yeah.
I've been with Commonwealth since Dolomite days, primary school days, so I'm quite happy with Commonwealth. I've been with them forever.
Showing that banking, a bit like faith, has many different views.
You've probably heard of influencers on social media, but do you know much about Finfluencers? They share tips on investing and budgeting and reach billions of people across the globe. Now there's calls to regulate them, as many aren't qualified to give financial advice. Rihanna Whitson reports.
If you want more information about what I am,
use your cryptocurrency.
Why don't you just start small? It's so confusing.
Hey everyone, and welcome back to the channel.
Queenie Tan has quit her marketing job to focus on making online videos about finance.
I wanted to create content for free to help people that maybe they don't have thousands of dollars to see a financial advisor.
The 23-year-old has several social media channels, and her videos on TikTok about everything from budgeting to investing have clocked up to 400,000 views. They bring in around $5,000 a month thanks to advertising revenue.
I'm not a financial advisor, and this is not financial or investing advice.
Ms Tan is one of a growing number of influencers who don't have a financial services licence. It's a trend that's coincided with millennials and Gen Zs piling into the share market.
My name is Mehdi, and if you live in Australia, listen up. I'm going to show you the easiest way to invest in property and make some passive income.
Experts say some could be breaking the law.
In Australia, it is illegal to provide financial advice without a license.
The popular hashtags used by Finfluencers globally attract huge audiences. FinTok has attracted more than 400 million views. StockTok has 1.4 billion, and crypto is reaching over 4 billion users.
Well, I think speaking about your personal investment experiences is a common phenomenon. We've seen that for forever and a day, you know, taxi drivers giving stock tips because they had a good run in BHP. And that's very different from recommending a financial product.
Financial advisors disagree and want Finfluencers brought into line with new regulations. The industry is particularly concerned about investors losing money in the volatile cryptocurrency market.
The mere fact that you're operating on social media shouldn't mean that you are exempt from all of those regulatory protections that other advisors are subject to.
ASIC wants people to dob in unlicensed Finfluencers who are doing the wrong thing and is worried about pump and dump scams, where people talk up a stock or cryptocurrency and sell when the price increases. But on social media platforms where evidence can quickly disappear, experts say ASIC is failing to keep up.
Is ASIC's role in this space to provide clear guidance, given that the investment landscape has evolved so much?
We know that ASIC is looking at this space right now and reassessing the role of Finfluencers. But there is an element of buyer beware. We want consumers to make their own judgment.
Finfluencers like Alex Nikolic, who also works as a corporate lawyer, don't feel qualified to make that judgment.
It would be really great to see more clarity from the regulator, but at the same time, most of what I share is personal information. I'm not encouraging anyone to make a particular investment choice.
Talking about money to a new generation.
And that's all from this summer series special on the finance industry. For more on those stories, head to the ABC News website or catch up with the latest on iView. I'm Alicia Barry. Thanks for watching.